This is John Paulamy of the Actionable Intelligence Alert. Today is Saturday, March 25th, 2018. This week we had an interesting development in the oil market, and it appears that on a technical basis, it looks like oil is starting to break out to the upside. Not only that, there are certain fundamentals, I think, that are coming more and more into focus that are validating the upside breakout in oil. And I want to go over it this week. So here's a chart of West Texas Intermediate crude. And as you can see, the chart goes back to October of last year. And you will notice that over the last week, we've had this big upside move in oil. It's up about $4 a barrel. What's interesting is that we had a breakout from this triangle formation that was in place here. There's a triangle, and the price broke out. Now, typically, when price moves into this triangle formation, it will either break obviously to the upside or downside. Typically, if you go to Investopedia or research triangle breakouts on Google, you will see that typically the triangle is a continuation pattern, and it usually continues with the previous trend. However, it can break or reverse and go opposite of the trend. So I thought it was very significant this week because of this break higher. Now, I'm not going to get into why that is. We know why that is. Inventories continue to go down around the world. Production is not keeping up with demand. And therefore, as inventory shrink, price is going up. This is just a review of the triangle breakout. The triangle can be a continuation or a reversal pattern, although more often it is a continuation pattern, and that's what we think we're seeing here. Now, I don't believe this is confirmed yet. We want to see obviously it's broken higher, but if it pulls back, it should pull back to where the top of the triangle was. It should bounce off and then move higher. And it looking pretty good technically, as far as there's room to go higher on the relative strength up here before it gets too overbought. And it looks like the MACD down here is crossed over and is heading higher. That's positive also. I think this is very intriguing, though, because I listen to a lot of commentary and opinion on various markets, and a lot of people just do not buy this oil rally. They are still thinking that, it can't go higher, lower for longer. Anytime it ramps up, shale is going to do this. It's going to take over. You're going to see all these rigs come in and all this production come online. I really think that people aren't paying attention to the cyclicality here, and the fact that the lack of investment over the last 3 or 4 years is now kicking in. I mean, we're going to see demand that possibly have demand growth around the world around 1.8 million barrels a day, and you couple that with 6 or 7% production declines, and you got to find a lot of oil, and we just have not been making the investments. So technically, it looks like it's breaking out. Here's the fundamentals. This chart is done by Art Berman. This is the comparative inventory chart, as you can see down at the bottom. Here's the comparative inventory, millions of barrels. Here's 0, 50 million, 100 million barrels, 150. You can see March 16th, we are now below zero. We are now, comparative inventory is now getting negative. And you will note that even though we are here, the price of oil based on previous times we've been down to this level is, there's no reason why the oil price couldn't be $5 a barrel higher. It could be at 70 right now. So we are now, what's interesting is that we are seeing inventory shrink even though we were in a shoulder season. We were in the season between winter heating oil needs and the spring when refineries, typically February, March, they are usually in turnaround, they're shut down, they're doing maintenance in preparation for the gasoline summer driving season. And even during the shutdowns and turnaround season, we were seeing continued draws on products and and comparative inventory. So this is the reason why I tell people you should follow me on Twitter and Facebook, because, you know, this is a guy, Art Berman. He puts this chart out every week. Um, you can follow him on Twitter. You can see it for yourself. And this is a dot plot, and you can see, you know, I mean, as we continue to draw, as we get into gasoline season, we're going to see these refineries coming back online, and they're really going to start pulling crude to ramp up for the summer driving season. So we expect, or I expect, along with a few other people that follow this, like Art Berman, guy HFI Research, some other folks, expecting further draws, and it's going to be a big surprise, I think, for the market as oil prices continue to head higher, and people still are in denial or not acknowledging or recognizing the fundamentals. So you can see that if we get to a situation where we've got down to a 50 million barrel draw, negative 50 million, I mean, you're up into the $100 a barrel for oil region. So that's what some people are forecasting. But I think we're going to move higher. I think it's going to surprise people. They're just not paying attention. They're just stuck in that mindset of, you know, oil's been down low, it's going to stay low, and they're just not paying attention, I think, to the change here, the inflection point that I think that we've reached. So, talking about shale, there's interesting articles I've read in the last couple of days or last week or two, and here are some quotes from the former CEO of EOG, which is one of the top shale players, one of the top oil producers or participants in the shale revolution. The guy's name was Mark Papa. He was a former CEO. He has left EOG. He's started his own company, another company. And it's interesting what he said in an interview with the Wall Street Journal a couple weeks ago. He said that he is eager to tell the assemblage, he was at a meeting with other oil CEOs, that a widely held view that shale oil producers can quickly ramp up production and sustain those levels if needed is wrong. Now, that I don't want to get into a logical fallacy of appealing to authority, but this guy was the former CEO of the best in class, best shale oil producer in the United States. So I would think that his opinion matters. It should be listened to. I'm not trying to get into a confirmation bias where I'm going around looking for people that will confirm my higher oil price theory, but I think it does take into consideration that I just don't think that 4 or 5 counties in West Texas can supply the oil that's needed for demand growth around the world. I just don't think it's possible. So I think that when the former CEO of one of the top shale producers says that it's a problem, it should be taken into consideration. He goes on to say that even though 99% of the industry is dead certain about certain things, 99% of the industry is often wrong. I have a minority opinion right now, but within the next year or two, I feel pretty strongly that's going to be proven out. So one of the things I wanted to look at is like, okay, well, what else is going on in the Permian that could restrict production growth? And right off the bat, we know that there are pipeline takeaway problems. There are problems with just getting sufficient frac crews. After the previous bust, there's been hesitancy on people to come back. You know, you're working in an oil field on a fracking crew, you get laid off, you go away for a couple of years, and all of a sudden they call you back, and you're like, well, do I really want to go out to Midland and live in a hotel room when I'm back here with my family, I got another job, I'm feeling pretty good. So there's a lot of that going on. There's just labor shortages now. I saw a report that the unemployment rate in Midland, Odessa is like 2.5%. There was an article in a local paper. The Dunkin' Donuts franchisee guy was lamenting the fact that he can't get anybody to work in the donut shop because every able-bodied male is working in the oil field. No one's going to work in a donut shop for minimum wage where you can make money as a roughneck. So here's some more about the labor shortage limiting growth in the Permian Basin. So here's from a Barron's article. Here's a guy that oilfield services guy, operations manager. It's an emergency, a crisis actually. It's causing major delays. They're talking about labor shortage. Here's another guy from tanktransport.com. Rehiring will be a slow process. It won't happen as fast as you need it. And then, of course, what we just talked about, some of those people didn't come back to the industry. They were burned and hurt. It takes a while to build that back up. And you got this is from Halliburton's operations guy in the Permian. So, you've got takeaway capacity because of the pipelines. You've got labor shortages. You've got the fact that, congestion of roads. I mean, as simple as that. And the idea that, if we grow world demand by 1.8 million barrels a day, that the Permian is just going to ramp up and take care of that. I mean, there's questions around the grade of the oil. It's very high grade. And what we're doing is we're exporting a lot of that light oil because the refineries on the Gulf Coast can't necessarily process it. So we're exporting a lot of light oil, and then our main suppliers of heavier oil, which those refineries are tuned up for, i.e. Mexico and Venezuela, they're having issues of their own. So there's a lot of things going on below the surface, and I think you really can't be U.S. centric about things because the overall global inventory is shrinking. And I don't think that the Permian Basin is going to handle all of this supply demand deficiency that's setting up. And I think both the Saudi Arabia, which is leading OPEC, and the Russians, I mean, I think so far they've held pretty good. There's not a lot of cheating going on, and I think they're going to hold back production longer than they probably should, and I think we will get an oil price spike. I'm still of the opinion that we could see over $100 a barrel oil within the next 12 months. So what's interesting to me, though, is the oil and oil field service stocks, they are still lagging the price of oil. And this is kind of bothering me a little bit, and I want to go over this. You'll see the top line here this is basically a chart that shows the percentage increase from basically the start of this chart, which is back in October of last year, till now. Oil is up 30% in that time frame since October of last year. So that's literally 6-7 months ago. And you will note that there was a spike in the oil field service stocks into the start of the year, and then they dropped off massively, and they just, not done anything for the last month and a half. And as oil price moves higher, you're not seeing the oil service stocks follow, and they typically do. So it's a little concerning because is the market telling us that this price spike is just temporary and the oil price is going to fall back? That's why the service stocks are not following. That is a possibility. But the data that I continue to look at and the people that are sharing information, it's just setting up for that supply demand imbalance. And one of the things that really interested me was, like I said, the shoulder season, you should have seen a build in crude, and you actually saw reductions in crude and products at a time when you should have seen builds, and that was during the turnaround season. Now we're coming out of turnaround season. Like I said before, refineries are ramping up, and they're really going to start pulling crude now to build up gasoline stocks, distillate stocks, because of all the traveling that happens in the summertime during vacations. So the only thing that I can say is that there's just zero interest in energy stocks at this time. I did a little bit of search. I didn't put a chart up on this video, but as a portion of the total S&P, energy is now like 5%. Typically it's like 10, 12%. I've seen it, not too long ago. Now it's half that. So it's at one of the lowest proportions of the S&P that it's been in many, many years. And it's just totally ignored and totally no interest. So I think what's going to happen here is if the oil price continues to move higher, if we get through $70, $75 a barrel, at some point people are going to say, hey, wait a minute, there's something going on here. And I think you're seeing a sentiment shift. And one of the things I think was the beginning of the sentiment change was the recent appointment late last week, of John Bolton as the National Security Advisor to the Trump administration. Mr. Bolton is a hardcore hawk against Iran. He hates the Iran deal. He's one of these guys that hasn't met a country he doesn't want to bomb. And I don't necessarily think that the Trump administration is going to scuttle the Iran deal, but there's starting to be a perception change. and you're starting maybe to build back that premium, uncertainty premium into the oil price when you start seeing things like that. So maybe that's the beginning of a sentiment change or a change in view towards the oil markets. I think there's a lot of complacency out there with the oil price, and I personally, even with the interest rate increases that are going on by the Federal Reserve, I mean, Fed funds rate is still like 1.75%. I mean, that's still easy money. They're way behind the curve. And I personally do not think that interest rates are what's going to derail this recovery and end the economic expansion. I think it's going to be oil prices when they get over 100. I think they're going to surprise the upside, and they're going to put the squeeze on the economic expansion over the next year or so as energy demand increases beyond what people have forecasted. And I think that lack of investment that has happened, as I've said before many times over the last several years, is going to, jump up and bite everybody in the ass. So this is concerning. This chart is a little concerning though, because, you would expect, you can see a little bit here, at the start of the year and into January, we did see the oil services stock start to close the gap with the oil price, but they fell off. And you have to ask yourself, why is that? So it's just either lack of interest, or maybe the equity or the market knows something that I'm not picking up on. However, I don't think that's true. I don't think that's accurate, because quite frankly, a lot of times the market's really not that smart. So my expectation is that as this price moves higher, the oil price moves higher, you're going to see more big announcements from a lot of the oil companies. They have to start investing again. It was a little disconcerting last week because they had the big Gulf of Mexico lease sale, and it really didn't perform well. So that wasn't a big vote of confidence. But we need to be patient. We're coming out, like I said, we're coming out of turnaround season. Over the next three to 6 months is where we're really going to see the big demand hit. And as long as we don't have a psychotic break in the economy, I mean, I think we're going to have record demand around the world, and I think the price is going to go up. I just don't think the world can supply the oil that's needed. So just wanted to touch on that. It's a kind of a big deal seeing that price breakout this week. We want to see if it's sustainable. Let's keep an eye on it next week and the following weeks to see if it's sustained. It wasn't a false breakout, but let's keep an eye on those inventories. So I encourage you to follow me on Twitter and Facebook. I put a lot of information out during the week. That's where you're going to see a lot of the reports on inventories, and that's really what's driving this market as far as I'm concerned. So please subscribe if you like these videos, and thanks for listening. We'll talk to you next week.